Hai, nama saya Vishnu adalah NEDUNCHELIAN, nombor matrik A196-041.
My name is SANJIVEE PREKASH.
Ini nama saya KISSHENDRAN lelaki Nagendan. Nombor matrik saya ialah A19-54-19.
Assalamualaikum and hello. My name is Muhammad Shakil bin Muhammad SHADIK and my matrix number is A196190.
Salam sejahtera, nama saya Nandika Nagaraju, nombor matriks A194782.
Salam sejahtera, hello, my name is LAXSHAN son of GANASAN, my matrix number is A196442.
Okay, let's begin with our objective and our overview for this presentation. The first is to construct an optimal risk portfolio using the Markowitz efficient frontier model. The second is to compute weekly return, risk, covariance, and correlation, which we will look into detail later. To use Excel solver to optimize the portfolio, which is by using the Sharpe ratio. And also lastly is to generate the complete portfolios for 3 investor type. Okay, so the data used for this project is based on 4 companies, which is Sunway Red, Sunway Berhad, PEKASH Group, and Public Bank. Okay, the data is based on the weekly price from Bursa Malaysia in the year 2024, and then the weekly risk-free is 0.000602198. Okay, this is the descriptive statistics for the 4 chosen company. Okay, that is based on the 52 weeks of price data from the year 2024. Okay, so from the data that we see, we can see that the PEKASH group, okay, has the highest average return at approximately 0.0178. Okay, and it also has the highest standard deviation, which is 0.0485. Okay, we can identify it by looking at the average weekly return and the standard deviation columns. So this tells us that PEKASH is a high risk, high return stock. Okay, and as for Public Bank, okay, which is PUBM, it has the lowest return and it has a lower standard deviation, making it least risky but also least rewarding. Okay, these differences in the average weekly return and the standard deviation helps creating a diversified portfolio. Okay, and different company has different average weekly return and different standard deviation. Okay, so now we will analyze how the stocks behave relative to one another using 2 key concepts, which are correlation and covariance. So I'll talk about correlation first, okay, which is the bottom table. So the correlation, it measures the strength and direction of a linear relationship between 2 assets. Okay, that means between 2 companies. So correlation usually it ranges between -1 to 1. Okay, and different values of correlation indicates different relationship. Okay, if a correlation it reaches near 0, that means there's no relationship. If it is exactly 1, that means they move exactly together. And if the value is negative, it means that they move in an opposite direction. Okay, if you see in the correlation table, we can see that PEKASH shows a negative correlation with Sunway W and PUBM. Okay, so this shows that whenever PEKASH increases, Sunway and Public Bank, it tends to decrease, and also vice versa. Okay, and then as for covariance, it shows how 2 assets move together in an absolute term. So a positive covariance means the assets move in the same direction, and negative means it moves in the opposite direction. And if we see for the correlation table, we can see that Sunway and PUBM has the lowest correlation, which offers a better diversification. So a lower or a more negative correlation, the better the diversification benefit. And from the table, we can see that Sunway and PUBM has the lowest. So it is this combination, it will significantly reduce our overall portfolio risk. Okay, so I'll be talking about the portfolio construction. Using the descriptive statistic in correlation, we calculated the overall portfolio's expected return. We have already written the formula here. The risk, which is the standard deviation, and also Sharpe ratio, using equal initial weights, which is 0.25. Okay, it's 25% for all the 4 stocks. So now I will be talking a little bit about the formulas that we used. Okay, first off is the expected return. So the expected return of the overall portfolio is equals to the summation of weight of the total investment in an asset multiplied with the expected return of an asset. Okay, that is the formula to find the expected return. Okay, next is the portfolio variance. So for the portfolio variance, okay, the covariance matrix of an asset return is multiplied with the transpose of weight vector. And that will give us our portfolio variance. And lastly, for the Sharpe ratio, okay, the expected return of the portfolio minus the risk-free rate of return and divided by the standard deviation, which is the risk of the portfolio. That is the formula to calculate the Sharpe ratio. And by using these 3 formulas, we get the value based on that formula, and we have already put it in our panel A. Okay, so now I'll be talking about the optimal risky portfolio solver input for panel B. Okay, so in panel B, in order to find the optimal risky portfolio, we use the Excel solver to adjust the asset weights that we set initially, which is 25%, and maximize the SARP ratio that we got in panel A, giving the best possible return for each unit of risk. Okay, so portfolio risk is calculated from the full covariance matrix. Okay, so if we see in the panel B at the weights part, we can see that for Sunway, we got 46.2%. For Sway, we got 7.7%. For PEKA, we got 9.6%. And for PUBM, we got 36.4%. Those are the weights allocated for each of the company. And the values in here are the covariance value for each of the company. So this new allocation gives us the risk premium, a new risk premium, standard deviation, and Sharpe ratio. And if you see the Sharpe ratio in panel B and panel A, okay, in panel B the Sharpe ratio is lower than before. This result is derived from a more optimized risk-return trade-off using the full covariance matrix. The goal, and like I said, the goal is to get the best possible return per unit of risk, okay, not just the highest return. So this forms the basis of constructing the efficient frontier and complete portfolios in the next step.
All right, so in this slide, we are looking at panel C of the efficient frontier portfolio summary. This table shows several portfolios constructed by varying the expected risk premiums, and it helps to identify the optimal risk-return combination from all of these. Okay, starting from the left, we have the minimum variance portfolio. This portfolio has the lowest standard deviation, which is around 0.0131, indicating the least amount of risk. However, its Sharpe ratio is also relatively low, which is around 0.342, which means less return per unit risk. As we move to the right, we see the portfolio with increasing level of expected risk premiums, ranging from 0.005 to 0.016. As the premium increases, so does the portfolio's risk or standard deviation, but this also changes the Sharpe ratio, because we know Sharpe ratio is risk premium over standard deviation. So when this increases, the Sharpe ratio also increases, which tells us how efficient the portfolio converts risk into return, which is, as we know in the risk return theory, when the risk of the portfolio increases, the return also will increase. The portfolio highlighted under risk premium 0.01 is the optimal portfolio. It has the highest Sharpe ratio of 0.512, making it the most efficient in terms of return per unit of the risk. This is what we call as optimal risky portfolio. So let's now take a closer look into asset allocation. In the optimal portfolio, Sunway rate holds a weight of 0.359836. Sunway head stock is at 0.2818, PERKA is at 0.269031, and PUBM or public bank is 0.08933. These weights indicate how much of the portfolio is invested in each asset to achieve this mass of risk return profile. So below that, you also see the capital allocation values, which shows expected return in this combining this portfolio with the risky assets. For optimal portfolio, the CL value is around 0.0099998889. Finally, the bolded row at the bottom confirms that this is the optimum risky portfolio used to draw a capital allocation line in order to see the overall efficient frontline model, and also it is the optimal risky portfolio. All right, on this slide, we see a visual representation of two key concepts in the modern portfolio theory, which is the efficient frontier and the capital allocation line, where which we'll call it CAR. So initially, we used Excel solver and we constructed the efficient frontier by finding portfolios with a minimum variance for a range of expected returns. So these are shown by the red points in the graph. For the efficient frontier represents a set of portfolios that offer the highest possible return for a given level of risk, or alternatively we call it like the lowest risk for a level of return. The blue line represents the capital allocation line. This line begins at the risk-free rate and extended through the tangency portfolio, also known as the optimum risky portfolio. The tangency point is where the capital allocation line touches the efficient frontier. This is the point where the Sharpe ratio is maximized. In simpler terms, also, the capital allocation line shows the best combination of a risky asset and also free risk asset combination of portfolios. The steeper the capital allocation line, the higher the Sharpe ratio, which means more return per unit of risk. This is also because we know Sharpe ratio is the slope for a capital allocation line. This graph essentially tells us how investors can construct portfolio that efficiently balance risk and return by combining risk and risky assets. All right, so in this slide, we're going to see demonstrate how the optimal risky portfolios can be tailored and suited to different type of investor type, which is risk-taking, risk-neutral, and risk-averse investors. So let's begin with the column at the left, where we will be showing all the allocation to risky asset, which will be denoted as 1, and then following by allocation to risk-free asset, which is denoted as 1 minus 1. So based on these allocations, we also can calculate multiple matrices like complete portfolio expected return, variance, utility value from all this return and risk, which reflects investor satisfaction given their risk preferences. So let's start with risk-seeking investors. So based on this, they need to allocate 150% to risky asset, meaning they borrow 50% to invest more in the risky portfolio. This aggressive approach gives them the highest expected return at 0.0073 and also the highest utility. So based on the asset allocation for this particular, their weights for SANJIVEE REIT, SANJIVEE Berhad and PEKA are significantly increased, especially for SANJIVEE Berhad at nearly 67% of their risky portfolio is allocated to SANJIVEE Berhad. And to see, they will allocate around 0.223145 into SANJIVEE rate, which is around 32%, and also around 60% more into PEKA. And then there will be like zero allocation for public bank Berhad. Okay, moving on to the risk neutral investors, they invest entirely in the optimum risky portfolio, which is 100% allocation and nothing in the free risk asset. So their expected return is 0.00575 and the utility is proportionate to their risk tolerance. Their asset allocation exactly mirrors the optimal portfolio we discussed earlier. So which is 35.9% in SANJIVEE REIT, 28.1% in SANJIVEE Berhad, and around 26% in PEKA and around 8% in public bank. Finally, moving into risk-averse investor, or we know that they cannot take much of risk. They split their capital evenly, 50% risk portfolio and 50% risk-free assets. So this gave them the lowest expected return among all of them, which is 0.0028, but also the lowest variance aligning with their desire for stability. Well, this is mean that even though the return is low, but this is the lowest risk because variance is the lowest, which is suits to their style of investing, which is low risk. And their allocation in risky assets are scaled down proportionally, reflecting their lower appetite. As we can see that they allocate 23% into SANJIVEE REIT and 0.3% in SANJIVEE Berhad, 3% in SANJIVEE Berhad, and 4% in PEKA, and around 18% in public bank. So the key takeaway from what we're going to see is the risk-averse investors seek safely by allocating more risk towards risk-free asset. Risk-neutral investors go all in to our optimal risky portfolio, and risk-seeking investors borrow at the risk-free rate to amplify the returns and accepting the higher risk in this particular process because that's how the nature of this investor as well. So I hope this whole demonstration will show how a single optimal risk portfolio can be adapted into complete portfolios that suit different investors, profiled through the changes in the asset allocations. Finally, as a conclusion, this project successfully applied the portfolio theory to construct an optimum risk portfolio using a real stock data from these four stocks we choose. By calculating the weekly returns, risk, covariance, and also correlation, we identified the best asset combinations based on the Markowitz efficient frontier. Using an Excel solver, we optimized the Sharpe ratio to form a tangency portfolio, which maximizes the Sharpe ratio and also which offers the highest return per unit of risk. The efficient frontier and capital allocation line help to visualize the trade-off between risk and return. And also be able to see the different investor types, which is like risk averse, risk neutral, risk-seeking investors were modeled with appropriate allocation between risk and risk-free assets. So as a key insight and also takeaway is diversification through assets with low or negative correlation significantly reduce portfolio risk without sacrificing expected returns. Thank you.